Want steady long-term stock returns? Start by getting to know the companies you invest in. And the key to that is understanding their financial reports. At the 1996 shareholder meeting, Warren Buffett said, "Over the years, I have found reading a lot of reports to be quite useful in terms of making business decisions." So, what's the magic of financial reports that captivates Buffett? Here are three key reasons. First, the financial reports reveal a company's business model. Public companies regularly release financial statements, including quarterly reports, semi-annual reports, and annual reports. These are goldmines for investors to understand a company. In these reports, companies explain their products, services, customers, sales channels, key performance metrics, and financial data. This is essential for understanding how they operate. Warren Buffett emphasizes the circle of competence in investing, and knowing a company's business model is a key part of that. Second, reading financial earnings can help you find promising stocks. Many well-known companies like Apple, Nvidia, Microsoft, and Google have growth stories that can be seen in their past financial reports. Analyzing these reports is key to forecasting their future performance. Besides these established players, if you're looking for the next rising star in the market, you may need to sift through financial reports to find stocks with high growth potential. Finally, reading financial reports can help you avoid high-risk companies. Though rare, stock market fraud can lead to big losses. Financial reports allow investors to compare a company's current financials to its historical data. Investors can catch any inconsistencies or warning signs and potentially avoid any pitfalls. Additionally, many struggling companies have disappointing financial data, which can lead to investment losses. Fortunately, financial analysis helps us make smarter investment decisions. Now that we know the importance of financial report analysis, let's see how to find and read them. You can find financial reports on the official websites of public companies or stock exchanges, but they're often too long or not beginner-friendly. A simpler option is Moomoo's Financials feature. It highlights key information like business models, operating data, and financial metrics. So how do we read financial statements? To check a person's financial health, we look at three things: how much they earn, their assets and debts, and their bank statements. For companies, the approach is fairly similar. We view their income statement, balance sheet, and cash flow statement. First, the income statement shows how a company makes money. It details the company's revenue, various costs, and expenses during a financial period, and shows the final net profit or loss. By reading this statement, you can track the company's revenue and profit growth, and trends in key profitability metrics like growth and net margins. Next, the balance sheet. It shows how much money the company has and owes. Think of the income statement as a video, tracking financial activity over time. The balance sheet is like a snapshot, showing finances at a specific point. It details the company's assets, their types, liabilities, their structure, and the net assets available to shareholders at the end of a financial period. The balance sheet helps us assess the quality of a company's asset and its debt repayment capacity. Next is the cash flow statement, which primarily tracks how cash flows into and out of the company. It tracks cash inflows and outflows from operations, investments, and financing, details earnings, expenditure, loans, and repayments. By looking at the cash flow statement, we can assess if a company is bringing in real cash from its operations, how much is spent on investments, and how dependent it is on outside funding. It's important to remember that these three financial statements are closely linked. For example, by viewing the income statement and the balance sheet together, we can assess how well the company operates and the profits it generates for shareholders. By combining the income statement and the cash flow statement, we can see if the net profits are actually resulting in real cash inflows. By reviewing all three financial statements, we can get a clear picture of a company's financial health and growth potential. In summary, understanding a company's financial statements is vital for stock investing. These statements reveal the business model, highlight investment opportunities, and help avoid risks. The three key reports are the income statement, balance sheet, and cash flow statement. analyzing them can lead to smarter investment choices.